So welcome everyone to the webinar presentation today, this evening, 1031 Exchanges with the Experts. Thank you so much for joining us. So today we have an expert panel, and I'm going to introduce everyone in just a moment. But first, I just want to put it out there that we are, here to answer your questions. We want to know what questions that you have. So while we're all going to do a presentation, we're also open to a Q&A interactive format. So please feel free to put in the chat what questions you have. And of course, we'll, stop during our presentations and make sure we're getting to your questions. So looking forward to that. But some of the topics that we are trying to cover tonight are, if you're thinking about doing a 1031 deferred exchange, or just trying to get educated on it, what are the important numbers that you should crunch before making that decision? What other real estate opportunities might there be that you could know about that could maximize your bottom line? And if you were to do a 1031 exchange, what do you need to do to prepare? And are there any pitfalls that you should know about and be able to avoid, right? It's a big one. So our panel tonight is myself. My name is Carrie Gatto, and I'm a realtor with about 11 years experience in the greater Boston area. I'm with Keller Williams Realty out of the Cambridge Somerville office. And that's my team name. Big Picture Realty is my team name. And then of course we have a CPA, and that's Michael Geher. And he's with Peter J. Gilman, PC. He happens to specialize in working with real estate investors.
Sorry, it's pronounced Gear, actually.
Gear, sorry, thank you.
Like the actor.
Thank you. I see it in writing all the time, not so much, thank you. Michael Gear, and he specializes in real estate investors and working with them to prevent the biggest expense that investors have, which of course is taxes, or minimize, I should say. And then someone you need to have on your team as well is Lynn Bagby. She's a 1031 qualified intermediary, and she's with Asset Preservation Incorporated. And then we have the dynamic duo, Wolfgang Cease and Keegan De Silva with Great Point Capital LLC. They're going to talk about DSTs, or Delaware State Trusts. Okay, so welcome panelists. Thank you so much for being here and lending your expertise. I'm going to kick it off with talking about the properties and the real estate itself. So I already introduced myself. I have kind of created a niche with investment properties, multifamilies, and on the listing side, even more specifically. And I have a passion for real estate investing. I wrote a book about real estate investing called You Can Have It All with Real Estate. You can find it on Amazon. And so obviously this is a huge topic. When anyone who owns a multifamily is thinking about selling, it comes to mind. So what exactly does a 1031 like-kind tax deferred exchange mean? It's an amazing tool that can be used to reinvest all or part of the proceeds of the sale of an investment property, okay? And as you probably know, there is a timeline attached to it. It's 45 days to identify the property and 180 days to actually close on the property. And I'll let Michael and Lynn explain that a little more. And it allows you to defer the capital gains tax until the sale of that next property, or perhaps indefinitely. Okay, so I wanted to give you like a little market snapshot today. Market's been crazy lately. So this is a year-to-date market snapshot for multifamilies in Massachusetts, and it's showing you year over year the difference as well. So what we've seen so far this year is a severe shortage of inventory across the board. And as you can see, For listings under agreement year to date, there's been 10% less than last year, which even then was very low inventory, very tight market. So the first quarter, there was a very low volume of sales happening. And for listings sold year to date, -8 year over year, same story. But look at the prices. You know, this is what happens when inventory is really short and demand's really high, prices go up. So the average price of multifamilies year to date is 20% higher than last year, which is just so inventory is starting to pick up, and a lot of the factor that goes into that is the interest rates have changed. So it's putting a little more urgency into those potential sellers that were holding off. They know that as the interest rates increase, it will put downward pressure on prices. So they're choosing to go ahead and list their properties. So there's a little bit of an upswing in inventory levels. And month supply of inventory, it's still on the low side. So don't get me wrong, it's still a seller's market. No doubt about that. Anything less than 6 months supply of inventory is considered a seller's market. And average days on market is just about 48 days. So lower than last year. And again, that's a measure of the heat of the market. So things are moving quickly. Does anyone have any questions before I move on? Great. All right, cool. So what we have basically is supply versus demand is out of whack. Inventory is historically low. Demand is high due to those interest rates still being relatively low. Prices are the highest ever that they've ever been, and it's a great seller's market. And of course, these dynamics won't last. They never do. Markets change on a dime, as we know. So if you're thinking of selling, this is a great time to do it. Bottom line, So does it make sense for you to sell now? Well, here are some questions that you could ask yourself to analyze that question and figure it out. So if you do have a lot of equity, and a lot of people do, if you've owned a property for 10 years or more, you probably do, and maybe it could be redeployed or leveraged in another way to get a higher return on the investment. Also, because rates are still low and they're inching up, maybe if you're thinking about upgrading your portfolio and rolling into a higher price property, it makes sense to do that while the rates are low if you're going to use financing, right? Get a better cash flow, do a 1031, and get a bigger property. Or if you're open to investing out of the state or even out of the country, maybe, a 1031 would be a good way to do that. You can do it out of the country, but you could do it out of state. And again, just improve the return that you're getting and make your money work even harder for you, even smarter. And maybe another option is to invest in a more passive asset class, such as DSTs, which Wolfgang and Keegan are going to speak about in a little bit. Or perhaps it's just time to cash out and retire. I mean, life is short. Why not? Prices are higher than they've ever been. So, some food for thought. And oftentimes people ask, well, what about condo conversions? If I have a 3-family, maybe I just am, leaving money on the table if I don't do a condo conversion. And my typical answer, unless it's a unique situation, but The condo conversion option typically is a little more time intensive and costly than people realize. So I would just advise you to really make sure that you do know what it takes for the renovations, especially now, because as we all know, renovations cost more than they did, a lot more than they did before COVID. There's a lot more delays. And in some cases, the condo market has taken a hit or is a little more unpredictable than it was before COVID. So these are factors to think about, and it might make sense for you in certain cases, but if you're not a developer, you don't have a good grasp on the numbers, just be really cautious. And I'm happy to, look at your property if that's something you're thinking about and see and help you kind of run those numbers, see if it's a good choice. And, because the market has been so crazy, as we saw 20% gains year over year, you're definitely going to want to get market analysis. I mean, that's the first thing. So don't trust Zillow, because Zillow has never been inside your property. They don't know what kinds of things you might have done, updates. They don't know the difference between one street and another, how that can really fluctuate in a neighborhood. So I would suggest an appraiser or a realtor. An appraiser does cost money. Realtors usually do it complimentary. I can give you a market analysis even without walking through the property, a ballpark, or do a full market analysis. And I'm also happy to offer some simple tips to maximize your sale price as well. So, and that's all complimentary. So feel free to ask about that. So next steps would be, I'd recommend getting your market analysis. And even if you're not sure yet whether you want to sell, just find out what your property's worth, because it's good to know that. It's a big asset and it's good to know the value. Then understand your tax implications. Talk to Michael. Think about your goals, your personal goals. What's important to you? What's your next move? And then you'll be prepared to make a well-informed decision. So that's all I have from my end. So feel free to email me or call me for a complimentary consultation, and I'll answer any specific questions you might have. If you have any questions right now, feel free to put them in the chat, but I'm going to stop my share, and I'm going to introduce Michael Gear to talk about taxes.
Hi, everybody. How are you doing? Thank you so much for attending tonight's seminar. I'm Michael Gear. I'm a CPA. I work in downtown Boston, and I've been in tax, public accounting since 2004, and it's just mind-boggling how much the rules change. So far, since I've been in public accounting, the rules really haven't changed much or not at all, to my knowledge, on 1031. I've probably done anywhere from like 8 to 10 of these over the course of my career, and they're complicated on the number side. I'm going to get into that. The first thing actually I'd like to talk about today is just, in the news back in March, Biden has a proposed 2023 budget, and he's basically in the budget. There's a little provision in there to limit 1031 to $500,000 for taxpayer, and $1 million for married filing joint returns. There was also talk of this last year in one of the bills being pushed around. I can't remember if it was Build Back Better or something else, about getting rid of 1031 altogether. And we know that didn't make it. If this were to go through, it would be applied to exchanges after December 31st, 2022. Not sure if people are really rushing to get exchanges done in anticipation of this law actually being passed in the budget. The budget starts October 1st. But I just think that based upon last year and based on the current makeup of Congress and the Senate and what could be for the future, and along with there being really strong real estate lobbyists in Washington, I don't think you're going to get, I don't think this is really going to stick. And I don't think this is going to be in the final budget that goes through. That's my personal opinion based on what I'm reading. So what I see on my end, I'm the CPA, and sometimes the clients say, hey, we want to do a 1031 exchange as they're doing the sale, and that's awesome, that's great, they should. But sometimes it's March of the following year, and then the clients say, oh, we did a 1031 exchange, here you go, here's everything. So we can be proactive in the planning, but we can also be on the reactive side. So on the tax side, you don't need to do anything until you file your tax returns. So if you go into a 1031 exchange and you get everything done administratively in 2022, and you're an individual taxpayer, you're gonna report this on your 1040, and how you report it on your 1040 is Form 8824. Form 8824, it's a simple form. There's just, I don't have the form in front of me, but like 3-4 numbers. And the form itself is easy to repair. It probably takes about 10-15 minutes to put in the numbers, but getting the accounting right that goes into those numbers takes a lot more work and effort. And that's where you really want to have a CPA. You don't want somebody that, hey, look, and there are good enrolled agents out there. There might be somebody who's not a CPA that's a tax preparer that's done this. That's great, but I would have a CPA prepare this, because the IRS is going to look at a CPA's preparation of a like-kind exchange a lot more favorably than someone who is not a CPA. CPAs generally have a stronger accounting background. That's the main reason more than not. And just keep in mind, if you're an individual, you own the building, it's on your 1040. If this is a partnership and the partnership does the 1031 exchange, it's going to be reported on the partnership return. Same with a trust, same with an S Corp, C Corp. And the good thing about like-kind exchanges is that it's very liberal in terms of the types of real property that can be exchanged. The IRS, it's broad on what you can define as real estate, as real property. It's residential real estate, there's commercial real estate, there's apartment complexes, tall buildings, cell towers, storage facilities, warehouses. You don't, if you own a couple of single family homes and you want to do a like-kind exchange with those, you don't have to exchange them for another single family or 2 single families. You can say, hey, I want to get into the commercial real estate sector. So you can exchange a single family for like, I want to go into commercial now. You can do that. Or if you're in commercial, you can say, I'm sick of commercial. I'm sick of being in a recession with no tenants. I want something a little bit more streamlined. So you go and you can do commercial for residential. You have all these possibilities to exchange properties. 1031 like-kind exchange. I'm going to talk on the basics of the administrative side, and Lynn's going to talk more about the more in detail and more complex areas of the administrative side of these exchanges. But just keep in mind the basics. You don't want to say that with your CPA, you don't want to sell your property in 2022, and then the following year you're like, hey, I sold my property, I want to do a like-kind exchange. because that happens very often. You want to call your CPA the minute that you're thinking about this so that they can introduce you to someone like Wolfgang, to someone like Lynn. It's very important because with this, you have to get your qualified intermediary in place, and you got to have all the identification. You got to have all the I's dotted, all the T's crossed. The basic rule is, the basic transaction, you sell your property. Okay, you sold it. Well, you have 45 days to identify a property. Then you have 180 days to actually close on the sale of the acquisition of the new property. You also can do a reverse exchange. That's where you first buy a new property, and then you have 45 days to identify the property you're going to sell, and then you have 180 days to actually sell that property. The more, sometimes I get a client, they, think about a like-kind exchange and they have a gain on it, but the gain, sometimes it's maybe like a small rental property. It's not, they've owned it for like 5 to 10 years. There's, maybe maybe it's like 10 grand in tax. Maybe it's not essential to go into a 1031 exchange with paying such a small amount. But just keep in mind that the bigger the asset, the more that it's appreciated. If you bought, a $500,000 home back in 2005, and now it's worth $2 million, and you want to do another exchange, you want to do an exchange with a $1.5 million gain, maybe it's depreciated substantially, maybe you got some bonus in there, who knows? Maybe it probably makes a lot more sense to actually do a 1031 with an asset like that. So again, the more appreciation, the more it makes sense. The IRS, there's no explicit rule, but everybody uses the 2-year rule. It's just kind of a common rule because it's based on a court case that happened where the judge said that the asset was held for 2 years. Didn't say anything about it must be held for 2 years, but everybody uses the 2-year rule. So if you bought a property, before you go into a 1031, you want to own it for 2 years. And just keep in mind that you might be thinking about doing an exchange where you own a property in Mass, but you want to buy a property in New Hampshire or another state. Okay, for federal, that's going to be recognized as a 1031 exchange. You'll get non-recognition on that. However, if you sell a property in Mass and replace it with a non-Mass asset, then it's going to be taxable. The sale is going to be taxable in Mass. You would need to exchange a Mass asset for a Mass asset to have it be non-taxable Mass, and that goes the same for any state that recognizes income tax. You might have a situation where you sell a property for $2 million, and then you replace it with a $1.5 million, and the seller of the building that you're buying is like, oh, all right, you know what? Here's $200,000. I'm sorry, here's $500,000 to make up for the make up for the difference. So that way you get fully compensated. You end up with as much assets as your $2 million building. So the 1.5 of that would be deferred, but the $500,000, that's considered the cash, that's considered book, that's going to be taxable. But if you use that $500,000 to make improvements to the building or put a new expansion or addition onto it, then you get that $500,000 to be treated as deferred and non-taxable. And just keep in mind that you can straddle. Like, you don't have to do everything in the calendar year or the fiscal year that the partnership is on, or the individual's going to be on a calendar year end. You can straddle that. So you can sell your building on 12/31/2022, and as long as you meet the 180-day requirement in 2023, that's going to be deferred, and you get the deferment recognized for tax year 2022. And you are going to have to put your 2022 tax return on extension. Actually, if you did a 1031 in the first place, you probably should put your tax return on extension, so your accountant has the space and time to actually make sure that the accounting is really good and that the returns prepared properly. Just a couple more things. Partnership, when it's entering a 1031 exchange, it needs to be in the same form. So you can't have, one partner wanting to do the exchange and then the other three partners say, nope, we're selling the building, we're out. Because if one person's left, the partnership goes away. And the entity that person won't be able to do a 1031 exchange. You could bring in a new partner. That's one solution. The other solution, and it's probably a little bit more common, is something called drop-in swaps. And that is where you want to make sure that it's done, give it a year time. You own a building. It's owned by, the partnership owns a building. And the partnership, one partner in the partnership wants to do a 1031 exchange, and the other three partners like, nope, we want to sell it, we want to get out of here. So they do something called a drop-in swap, where the title of the building changes from the partnership to generally it's different single member LLCs, and they hold it as tenants in common, not jointly. They hold it as tenants in common. That way, that single member LLC of the person owning it that wants to do the 1031 that lives on, and it can go and qualify for deferral on the exchange and the acquisition of the new building. And just again, keep in mind, you bought a building years ago, you spent $1 million on it, and then you taken depreciation over the years, and now it has a net book value of $500,000, and you exchange it for, because it's appreciated a lot, it's a new $5 million building. The basis in that new building is not going to be the $5 million. It's going to be the old basis net of the low basis of like $500,000 or whatever it is. And of course, the things that are going to increase basis are improvements to the property that you spend. Depreciation increases it. So down the road, if you decide, hey, I'm going to sell that building for $10 million, then you'd have a big gain. Because your original basis isn't going to be what you bought it for at $5 million. It's going to be a lot lower. So you're looking at probably an $8-9 million gain down the road. That's just an example. The other option is a lot of people who are in real estate, they keep doing 1031s, so they don't have to worry about recognizing the gain. The other option is if the owner passes away at death, they get the estate value, they get the step up in basis. So that's another way to avoid the gain. I think I've talked enough. I'm going to pass the torch on to Lynn. Thank you very much. Michael Gear, CPA.
Okay, can I share my screen now? Let's see. Where are we? You know what? I basically wanted to go over what, it's not pulling up. I basically wanted to, I just don't, I've got another presentation here, here it is, hold on. I wanted to go to review some of the things Michael talked about and go into a little bit more detail. So I basically have, hang on a minute. I've got to wait to
this. You can see it now.
You can see it? Can you see
Yeah.
everything, or do you see? Okay. So basically we're going to talk about some very basic things. I have one slide. Let me go to the next one. Can you see that one? All right, great. So Michael covered, and thank you, Michael, because you covered basically a lot of information in a really short period of time. So I'm just going to preface this by saying this tax code not in the format we have today, but started back in 1921 is when it was codified. So it's important to know that if you're just now learning about 1031s, it's not new. It hasn't been around since 1990. It's actually been in effect for a number of years, but the 1979 Starker case made it more like what you're used to today. So when you have investment property that you've held for productive use in trade or business or for investment, is the definition of 1031 qualifying property. It's not just that, oh, I don't live there, but if you don't live there, then it's probably a good idea to talk to Michael, talk to a qualified intermediary, and see if you've got the requirements that would make it meet a 1031 exchange. So again, what does productive use in trade or business mean? It means that you're collecting and reporting rental income, whether it's residential, commercial, or mixed use, or you're running your own business out of it. Now, if you're in a situation like that where you're running your own business, I would suggest that you go to your CPA like Michael to talk about how you've kept your books, what's going on with that, so it doesn't look, oh, well, you've been working out of your house, like that could be a hobby. There's things that you would probably need to show that shows that you had a legitimate business, that you're running yourself out of that property, or that you've held for appreciation like raw unimproved land. There are a lot of unique other types of real estate to purchase, like and exchange. Michael mentioned many of them. One of the ones I did most recently were air rights over a building in Brooklyn. And the person sold those air rights and they purchased an apartment building in Jamaica Plain here in Massachusetts. So again, that was a really good example of trading asset classes. You'll also find situations where people want to sell a property in a vacation area. Second homes most likely do not qualify, even if you've had a little bit of rental income. There's special requirements on Section 1031 about qualifying vacation homes. It's called Revenue Procedure 2008-16, which actually gives you a holding period either before a sale or after a sale of 24 months. So to expound on what Michael said, it's a situation where people say, oh, you hold it for 2 years. Well, there's 2 sections in the tax code that actually give a holding period. 2 years is one of them, like Michael said, and that's when you do a related party swap. Like if you're going to trade properties with a related party, you have a holding period of 2 years. Vacation home guidance says 24 months. So if you look at from the date you purchased the property to the date for a 24-month period, you could actually go into 3 taxable years. So we're going to expand what Michael said to 2 or 3 years based on what your intent was at the time you bought the property, what was going on during the time you owned it, and what was happening at the time of the sale. I also wanted to address another item about people that Carrie had said about people that have multifamily properties. And Michael, since you're muted, you can either shake your head yes or shake your head no. Okay. So I have a lot of people coming to me that have owner-occupied, they have a 3-family property, say a 2-family, a 4-family, 6-family, what have you. They've owned it for several years. Let's say it's longer than the 2 or the 3. And they, or about that time, and they decided they want to take that multifamily building and convert it into condominiums. So my first question to them is to say, have you talked to your CPA? Have you talked to Michael? They'll say, no, somebody told me I could do that, or I read about you could do that. Well, as a qualified intermediary, I'm not permitted to provide tax or legal advice. But if you're working with a qualified intermediary that's really looking at your situation, they're going to guide you to your CPA, because my question is, did you change the nature, character, and use of the building when you went to convert this multifamily property into condos? Here's why. If you've done a lot of capital improvements to the property after the tenants move out, and regardless of how long it takes you to use them, if you've converted the nature, character, and use of the property, it might be considered property held for sale and wouldn't qualify. It could also look like dealer inventory, and maybe it wouldn't qualify. That is not my call to make. Based on situations, I have some CPAs say that you can sell them off one by one. I have other CPAs based on the situation that says you can't. So it's very, very important, if you are out there and you own a multifamily property, that you are having that conversation, not just doing it because somebody you talked to did and their CPA said it's okay. lots of people are now in a situation where they have owned a property for a number of years. They're maybe getting close to retirement. A passive investment property that makes a good replacement property might be a DST that Wolf and Keegan are going to talk to you about, because those are passive investment opportunities that qualify under Section 1031. They're institutional grade, governed by the SEC. Wolf and Keegan are going to go in more about that, but that's a good alternative as well. So we talked about some types of different real property and what qualifies. I also want to take a moment to talk to you about an owner-occupied multifamily. What's that? Guess what? It's a property that maybe you live in a unit and you rent out the other 3, or you live on a farm and it's a working farm, or you own a motel and you reside in part of the property, or a bed and breakfast and the rest is rental. How is that classified? That is called a split treatment transaction. It can qualify for both tax codes. It can qualify for the 121 exclusion, the primary residence exclusion on the portion you live in, and 1031 for the investment pieces. So if I can just talk through a quick example, suppose you have a property that you have on the market. It's a 4-family. It's listed, or you sell it for $1,065,000. And I gave that price because in order for you to have a full deferral, you're buying at an equal or greater value than you're selling, right? But the $65,000 represents the 4 allowable costs of sale here in the state of Massachusetts, which would be real estate commission, tax stamps and recording fee, attorney's fee, qualified intermediary fee. That gives you a net sales price of $1 million. But you live in a unit. It's a 4-unit. Let's just say all 4 units are the same size. Michael can attest to the fact that that's not always the case, but for ease of example, it is. Each of those units has a net value of $250,000 each. So you could take the primary residence exclusion on the gain of up to $250,000 if you're a single filer, $500,000 married filing jointly. The remaining $750,000 would be the net, the minimum requirement for equal to of how much at a minimum your next investment property or property should cost. So just keep in mind, if it's an owner-occupied multifamily property, you may qualify for a split treatment transaction. Michael also talked about the full deferral, and I just did too. You're buying equal or greater in value than your net sales price. People say to me, what about the mortgage? The mortgage is a financing tool. What's the value of the property? Someone's agreeing to pay you $1,065,000 for the property. That's how much it's worth. The IRS will allow you to deduct those 4 allowable costs of sale. Its net sales price is $1 million. You must identify and purchase other investment property that totals $1 million at a minimum to get a full deferral. And all the cash after your closing costs and your closing cost and your remaining mortgage balance is paid comes to the qualified intermediary, and it is wired out for your purchase of replacement property. You bring in new mortgage money for the difference. Now, that said, how does a partial exchange work? You're going to Michael to find out, what is my tax cost basis? Other words are net adjusted basis, depreciated basis, and the property. It's the tax platform from which your capital gain is calculated. So if you want to have a partial exchange, you need to buy other investment property or properties that's somewhere between the tax cost basis and the net sales price. Buying at or below the tax cost basis does not allow for any gain to be deferred, and therefore the whole sale is taxable. So just the key takeaway here is, remember, one of the things is that it's just for a partial exchange. It's just not a matter of buying a property for whatever price and paying taxes on the difference. There's a formula for it, and that mortgage value is part of the value of the property. Next item would be the timeline. So from the date you close your sale, you have a 180 calendar day timeline to acquire replacement property, which is identified by day 45. So the first 45 days of that 180-day exchange period, it's within that. Ideally, you're out looking for replacement property even before your property closes. You are able to enter into contracts. You're able to negotiate and put down a deposit on that property that you want to buy even before your sale closes. So when's a good time to do that? Carrie, you can probably attest to this. It may be once you find that your buyer's not going to fall away, which could be a couple of weeks before closing, because there's lots of contingencies and contracts that they say the buyer can walk if the appraisal doesn't come in right, there's a title insurance issue, or the inspection doesn't work out okay. So you may want to wait to start making deposits on property and entering into a contract before your sale until you know your buyer's not going to fall out. Then your timeline is going to start the date you close the sale. This is closing date of sale driven to the final purchase date by day 180. Upon receipt of funds from the closing of your sale, you receive an acknowledgement that you received the money, that the QI has received the money. You also get a copy, you get your identification notice and your identification rules. I'm not going to go into the 3 different property rules now, but there are 3 different ones. Again, the goal for full deferrals to buy equal or greater in value than you sold. And that's a conversation you must have with the qualified intermediary so you fully understand how to properly identify and the difference between property rules. There was something that just was running through my mind while I was talking, and this 5 or 10 minutes doesn't give me enough to cover all my 21 years of about probably somewhere between 10 and 15,000 exchanges that I've been a part of. So I apologize. It might come up in a Q&A. So Carrie, is there anything else you want me to touch on that Michael didn't touch on that you might want to chime in? I don't know how much time I have left because I didn't even look at the clock.
Yeah, no, I mean, you guys have given so much information. I learn something every time we do one of these, so it's great.
I know what I
think
was
the
gonna
bottom
say.
line is,
I know what I
oh,
was
go
going to
for it.
say. Besides calling your CPA, I have a lot of people that do TurboTax. He's absolutely right. If you're doing a 1031 exchange, you ain't doing TurboTax. It's not gonna, they don't have all the features. It's imperative that, like Michael said, when you are even thinking about listing that property, if you saw me shaking my head and smiling, yes. When you are even thinking about listing your property with Carrie, you're going to contact your accountant, or if you don't have one, check out Michael. He's excellent at what he does, and the qualified intermediary. Even though the qualified intermediary can't give advice, we listen to your what's going on, and we're going to look for red flag issues, things that may be in a gray area that you need advice from the accountant for. But realize, if you go and you sell and close on your property, and you were to call me that day after the closing, or a day after, or a week after, you have no opportunity to use Section 1031. These must be set up prior to the sale because of the way the documents work. This fully executed signed documents need to be in place at the time of the closing of the sale. If they are not, and you close the sale, it's too late. It's not a matter of, oh, I closed my property and I didn't take the check. It's too sorry, game over. It's too late. So, and the other thing too, when you're talking to 1031 about people, with other people, if they're not a CPA and they're not a qualified intermediary, don't listen. Just question what they say. It's amazing how many people think they have 90 days to identify a property. I think there's something in mortgages that's 90 days and they get confused. And the other thing that Michael touched on is tax ownership. Tax ownership has to stay the same. The same taxpayer must be the same taxpayer on the new property. So if you're thinking about making changes, let's talk before you go even list the property, and talk about your hopes and dreams. Thank you. I'll wrap it up.
Thank you, Lynn.
You're welcome.
Yeah, I was just going to mention, bottom line, you can't know everything about all of this. So that's, why you need to have a good team, right? A good team of experts.
Perfect. Well, thank you, Lynn and Carrie and Michael. As always, it's just a wealth of knowledge, and you guys, great presentations. I share my screen. I think you have to unshare, Lynn. Perfect, 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 perfect. Thank you, thank you, thank you. And so We will be efficient because some of our presentation is overlap that we do not have to go over. But again, thank you to all the panelists. And this is, everybody who's attending tonight is very lucky to be able to learn from everybody on this call. And what Keegan and I are going to talk about is just a tool, a vehicle that you can exchange into, which is called a Delaware Statutory Trust. But real quick, I'll talk about our firm for a second, Great Point Capital. It's been around since 2000. We focus on alternative assets, specifically Delaware Statutory Trusts, opportunity zones. We do some easements. We just a lot of tax deferral strategies. The majority of our client base is high net worth real estate investors, and it could be anything from people that own multifamilies to portfolios of condos, commercial properties, etc. We also have an investment banking arm as well as an advisory separate entity that's wealth management. Keegan and I focus on the 1031 exchanges and other tax deferral strategies. So who am I? Wolfgang Cease. I work out of Beacon Hill. My partner is Keegan De Silva. I'll let him say something about himself here in a minute. Call myself a brick and mortar financial advisor. As mentioned, the majority of our clients, high net worth real estate investors. I'm a 1031 expert. I specialize in Delaware Statutory Trust. We also deal with opportunity zone funds, which are vehicles that you can defer a capital gain or a portion of a capital gain, but we're not going to talk about that today. I'm also a landlord and real estate investor, both actively and passively, and I've completed my own 1031 exchanges as well. Keegan, do you want to talk about yourself for a minute?
Definitely, yeah. I've been working with Wolf here for a couple of years. I specialize in due diligence on DST opportunities. Again, Wolf has a lot more experience actually doing them himself. So again, we kind of team up for me to give some access to product and the diligence on that side. And Wolf is very good with understanding the process, the rules that it entails, and making sure that from a timeliness perspective, you're connected with all the necessary people at the right time so that you can have a very easy 45-day window, because we know once that begins, time seems to move a lot faster.
Perfect. Thanks, Keegan. So I'm going to skip over. We all know what a 1031 exchange is. This is just a simple illustration that if you bought something for 400,000 and sold it for 1.1 million, you would have roughly $238,000 in tax liability if you paid taxes. And that does not include state taxes. And intentionally, we left that blank because we deal with people across the country. But at the end of the day, you walk away from your sale, you have 861,000 minus any state taxes to deploy versus 1.1 million. You're in a substantially stronger position being able to utilize the higher amount. So that's why everybody does 1031 exchanges. This is what qualifies.
Wolf, I just wanted to mention, you wisely included the 3.8%. And when I talk to people about them selling a building, they're like, oh yeah, it's 15% and 5% for mass.
Yes.
And I'm like, don't forget about the 3.8% net investment income tax.
And you would be surprised while you mentioned that, like probably 70% of clients that Keegan and I deal with have never heard of the 3.8%. And
yeah, it's on their return probably every year.
Yeah. And shockingly, a significant amount of people don't know about the depreciation recapture, which is could be a substantial amount of money. So thank you for pointing that out, Michael. You're absolutely correct. So we've gone through this already. What qualifies for an exchange: rental property, commercial real estate, raw land, cell towers. air rights, fractional indirect ownership such as DSTs, which we'll talk about in a second. This does not include stocks, bonds, REITs, your primary residences, fix and flips. Talked about that, talked about that, talked about that. So the DST has been around. So the DST stands for Delaware Statutory Trust. It's been around since '04, and it's really picked up steam over the past few years. And while '04 sounds like a long time ago, as Len mentioned, like-kind exchanges have had their 100-year birthday last year. They've been around since 1921. And so DSTs have been around since '04, 17 years, 18 years. They're really starting to become more popular. And I'll just give you a couple of stats real quick on that front. In 2010, there was about $200 million in DST business done industry-wide. In 2020, there was $3.7 billion done industry-wide. Last year, 7.4 billion industry-wide. This year, we're on track for over 10 billion. And there's multiple reasons for this. And one of the biggest reasons, it's so hard to find replacement property, especially if you're, under $2 million. It's so hard. And, it goes back to Carrie's chart in Massachusetts or Carrie's stats in Mass. There's not many available properties. They're up significant year over year. And there's just a lot of people chasing investment properties, and everybody's selling because it's a great seller's market right now. But the beautiful thing about DSTs, it's a vehicle that if you don't find your perfect property, or you have boot, which is the excess, if you were sold something for $1 million, found something with Carrie for 900,000, you could come to us and place that $100,000 boot. So a DST, it's been around, it's picked up traction. It's institutional assets. Think an Amazon distribution center or a Class A multifamily or a portfolio of CDSs. These are institutional assets that allow small and large exchangers equal treatment and access to an asset that they may or may not be able to buy on their own, right? Like you could come to Keegan and myself and exchange 600,000 into a $450 million Amazon facility. And then we have a client call a week later and exchange 23 million, and they both get treated equal. They both get their pro rata share of net operating income. At the end of the year, they get their pro rata share of expenses, including depreciation. It's one beautiful thing about DSTs is that you get to use depreciation because you do own part of the asset. And then you get your pro rata share of appreciation, if there is any, when they sell the asset. So one more thing I'd say on this slide, and I kind of went off topic for a minute, but so when looking for a replacement property, a vehicle, such as the DST, we have all cash DSTs, and we have up to 87% LTV, loan to value DSTs. So we can blend a portfolio to match any debt level that an accredited investor would have. And again, this is for accredited investors. But so like if somebody has a 40% LTV, we can find DSTs or blend a portfolio of DSTs to replace that 40% debt that they had from their sale. I would also like to point out that debt in a DST is non-recourse. It's off your balance sheet. A lot of people come to us with large exchanges, and they love the fact that we can satisfy the IRS requirements for replacement of debt with the DST, and it's off their balance sheet. That all things being equal, they could go borrow. It's not on your credit report, but again, it satisfies IRS. Anyway, I know we don't have much time here, but a few of the characteristics of DSTs, it's completely passive. You're sick of the tenants toilets, trash, the terrible tease of being a landlord. These are completely passive. They're meant to be a preservation of capital. They kick off a modest distribution stream that will be sheltered. A good part will be if not all, will be sheltered from income taxes due to the depreciation you get to use and other expenses. You get to benefit from the expertise of an institutional manager and owner. It's non-recourse debt. Diversification is huge. You get to diversify. You know, we work with people all the time that have concentrated risk. They may have a bunch of assets in Boston or a large apartment building in Boston, and it's their nest egg. It's all they have. And DSTs give you the ability to spread your exchange out both geographically and also by sector, right? You could sell an apartment building and exchange into storage lockers in Florida, an Amazon in Texas, a multifamily in North Carolina, CVS's in Nevada, et cetera. Like those are just hypothetical examples, but it's a great diversification tool. It's a great estate planning tool. It's very easily divisible upon the assets going into an estate. And it's not a blind pull. These aren't capital raising mechanisms. I'll go in on the next slide briefly and just talk about the mechanics, but these assets have been purchased. Attorneys have turned them into a Delaware statutory trust, and they're just replacing equity. So there's no capital raise here. The beautiful thing about a DST is, hey, it's, you know, whatever the hold period of the DST is, when the asset sells, you're not married to the DST structure. You can either exchange into a new DST, you could exchange into a real property if you want it to be a landlord again. You could take the money and pay taxes, or there's a different type of DST that allows you to take operating units in an affiliated REIT, and that is a mechanism that you cannot exchange again, but that is an option with some of the DSTs. Anyway, I'll be real brief here, but what happens is a DST sponsor goes out, they'll purchase an asset, the attorneys will turn it into a Delaware statutory trust. If it does have debt on it, the DST will take a loan out on it. And then once it's all put into that structure, they'll send it out to due diligence departments at firms such as mine. We'll look at it. If we decide to approve it and that it's a, reputable sponsor, it's a deal that we feel as an investor will do well in, we will put it on our platform, and then Keegan and I will put it in front of prospective accredited investors that are exchanging, and we'll give them multiple options to choose from if they still want to do a DST. So one more thing I would say about a DST. These aren't development deals. These aren't value adds. Again, these are stabilized assets. If it's an apartment building, think, occupancy in the 90s. If it's a portfolio of CVS's or Walgreens, they're going to have a very long lease term, weighted average lease term of, 10 years or something like that. These are not something where, hey, you're going to triple your money in 2 years or anything like that. These are meant to be very conservative in nature. And again, they're stabilized assets that are meant to kick off a modest cash flow stream to the investors. Anyway, so here's an investor profile, somebody that's owned appreciated real estate assets. They're looking for estate planning, looking towards retirement. They like the passive cash flow, escaping a local real estate market, like maybe things have changed, politically or whatever in their city or whatnot, and they just want to get out, but they don't want to pay taxes. And lastly, having difficult, like, listen, like Keegan and I joke a lot that we are a lot of times second choice, right? Like we are backups for a lot of investors, and we'll end up in day 43, all of a sudden we'll become best friends with those investors. And so it, we see this a lot, people having a very difficult time in this environment, finding assets to exchange into that that are suitable for them, suitable for the investors. So this is just a sample list of a hypothetical menu of just what you could potentially see on a DST offerings at any moment. Again, triple net assets, we see a lot. E-commerce distribution centers, apartments are still about 50% apartment buildings, 50% of our business roughly. We see a lot of manufactured housing, student housing, senior living, self-storage, very hot sector right now. Here's just a case study that I'm going to end this with. This was a married couple in their 70s. The husband had a really bad health scare, and they've got a son in his 50s and a grandchild in college. They've amassed a very sizable real estate portfolio that they've developed and managed themselves. Their son has no interest in being a landlord. And we see this all the time. Keegan and I see this all the time. The kids want nothing to do with it. They want to spend the money, but they don't want involved in the family business. And they just received yes, it is kind of funny, but so true. They just received a very appealing offer for one of their properties. And this offer was for $20,750,000. They had a 54% LTV. So hypothetically, what we did was put them into this portfolio of everything from triple net assets to apartments, self-storage, corporate headquarters. And as you can see, we on the right-hand side of the screen, we use different LTVs and blended it out to equal exactly 54%. So not only did this couple get a diversified portfolio that is both diversified by sectors in the commercial real estate world, as well as geographically across the United States, it's kicking off a decent income stream. And they're starting to really think about estate planning. And this is, again, DSTs are very easily divisible once it goes into this state. Keegan and I deal with estate planning attorneys at least on a weekly basis, if not more. So I would just like to end Keegan and I's part of the presentation by just thanking all the panelists, and also just saying that this is generally one of the largest transactions that one will do in their life. It's not to be taken for granted, and working with a strong team, such as everybody on this call here, on this webinar here, is a wealth of knowledge. From Carrie, like I would refer people to Carrie any day of the week to sell and buy real estate. To Michael, we send clients over to Michael to help and consult on taxes. To Lynn, she's the best qualified intermediary I've ever met in my life, and she's just a wealth of knowledge. And then Keegan and I, we love what we do, and Great Point Capital always has a a very large menu of offerings, and we put the client's interests first. So anyway, you want a good team on your side, and I'll leave it with that.
So true. Thank you, Wolfgang. I'm going to stop the recording, and if anyone has any questions, please put them in the chat. And thank you so much. I can on the button. There it is. Okay.